Welcome back to Lem's Cryptoverse. Today, I want to try and kill three birds with one stone. There's a whole bunch of false narratives out there and memes and all kinds of crazy stuff out there. But some of them are understandable and some of them are not. Let me explain. So first, let's get started. Let me just minimize myself a bit so you can see these charts that I gathered up to show you. The first one is that the market and investors, they keep swaying back and forth from a month ago thinking that rates would go up. Then the labor report, two labor reports were strong, and then you start saying that Fed's going to raise rates by 50 basis points. But then because of the potential financial crisis, and I don't need to tell you what I'm talking about, you know what I mean, Silvergate, basically companies, banks starting with the letter S. They've had bank runs and have shut down. So because of that, now investors are looking for zero, no Fed rate cut, no Fed rate rise, and some are even looking for a Fed rate cut. And I've been, not to put myself on a pedestal, out of the last 8 rate hikes, and there I put them right up here for you. So this is going back 1 year. So we're going to lap now. We're going to lap the March meeting in the next day or two when the Fed FOMC meets again. And all those 8 times, I think I got them right every time. How did I do that? Okay, I cheated a little. I looked at some of the probabilities of Fed rate hikes and the curve and the dot plot. But I just think I have a good feel for the economy, what's going on, especially now, because I think there's a lot of false narratives. So let's go back over these 8 rate hikes. We could see, first of all, the Fed waited too long to raise rates. If you recall, it was over a year ago when Jerome Powell said, in a response to a question at a press conference, he said that the Fed is not even thinking of raising rates. And that was his big mistake. And ever since, he's been trying to play catch up. So I don't know why he raised rates 25 basis points on March 17th. But then I think he did the correct thing by raising rates 50 basis points and then 75, 75, 75, 75. I think they should have been more front loaded. So maybe 75 basis points, 75, 75, and then, incrementally going lower. So what do I think what's going to go on for the next meeting? And this is, I think it's March 21st, the next meeting, or 22nd. Basically, I think the Fed, and I'm very confident about this, I think the Fed is going to raise rates by 25 basis points at least. You think I know you're thinking I'm crazy, but I've been right before and I feel confident about this. Why? Because the Federal Reserve is backstopping. So what they're doing, they're backstopping the bank. So what they're doing is, it's almost like someone's hugging you but backstabbing you at the same time. What they're doing is they're supporting the banks in full, right? And we know about that. I'm going to explain more about that later anyway. So they're supporting the banks. So I think they don't need to worry too much about a bank crisis, even though that's what everyone's saying. But at the same time, the Fed needs to continue to slash that dragging of high inflation. Remember, the CPI is at 6%, and the Fed said that they would lower rates from 6% down to 2%. So that's a long, and 6% is now. Actually, it was even higher, it was 9%. So they need to lower inflation from about 6%, and I'm using the CPI here, but they also use the PCE, Personal Consumption Expenditures Inflation Index, regardless, and that's around 5%. The Fed said they're going down to 2%. Even if they don't go down to 2%, they need to keep tightening because inflation is too high. We all know about that sticky inflation, right? So if exclude producer-type goods, like commodity goods, that's gone down. But wages are still too sticky and too high because of the services in industries like leisure and services. People are taking vacations. The reopening trade, basically, everyone basically is trying to get out of the house. So I think I made that clear that the Fed is going to be raising rates by 25 basis points. And I'm going to talk to you a little about it later, but I just want to show you some more charts here. So here, the Fed has come to save the day. And because of that, there's going to be an influx, and this is from Bloomberg, there's going to be an influx of $2 trillion of liquidity. And there's also going to be more liquidity coming on, because don't forget, people stop talking about this, but we've got the debt ceiling coming on very soon. Within, we're at the end of March. We've got maybe 3 months, and then it's all over. So meaning the government's going to default on its debt. So because of that, the Federal Reserve is increasing liquidity. And also, liquidity is not just local. Remember, we live in an interconnected world. And if you look at China, China is rapidly injecting liquidity into the market. As a matter of fact, just last week, they lowered reserve requirements for banks. So that they've been increasing liquidity in various ways. So now we're going to talk about why there could be some increase in liquidity. But before we do that, I want to talk to you about what's going on at the banks. And this is a different take. So here, this chart is also from JP Morgan, and it shows, so this is a little complicated. Actually, it's not too complicated. It shows, it's complicated if you don't know the Tier 1 capital ratio. But what's shown is the impact of unrealized security losses. And there's another chart going around that everyone's talking about. I'm going to show you that chart in a moment. But basically, what this chart is showing is what the common equity Tier 1 capital ratio is, meaning the stated ratio versus adjusted. But so you can see two things. Number one, that the Tier 1 capital ratio, if you're not comfortable with it, you're not sure about it, this is a capital ratio that became really popular after Dodd-Frank. And these ratios are all good. Even the lowest ratio isn't that bad. Well, maybe the lowest ratio is bad. That's from USB. And what's sad about this, you can't see it. Let me just move myself here. Now, what's sad about that ratio, that's come from USB. So what's sad about that is that USB is taking over Credit Suisse. You would think that USB's credit ratio is better, but it's actually the lowest one here. But regardless, that's not what I want to talk to you about today. What I want to talk to you today is the adjusted for unrealized losses. You could see those brown or orange, whatever, dots, that they're much lower, especially for BAC and for SIVB. That's SIVB, as you all know, is Silicon Valley Bank. And this is why it had to be shut down, because their unrealized losses were huge. If you recall, there's a lot going on. Basically, the yield curve became inverted, and yields went up overall anyway. And so depositors, because they weren't getting any money, the rates received on bank deposits are near zero, even though market rates are much higher. So investors were taking money out of banks, not just Silicon Valley Bank, all banks, all over the world. They're removing those deposits and investing those deposits elsewhere where they can get much higher yields with hardly any risk. They could buy 2-year notes, for example. They could get CDs, buy CDs. So that's what's happening. And this is what was causing the bank runs all over the place. Now, if you look to the right, you're going to see FRC. That's a pretty low number, too. But it's not that low, but that's First Republic Bank. So First Republic Bank, if I recall, I think they've got 2 backstops already, or 3. They've got all the major banks giving them billions of dollars, like $5 billion per bank, I believe. And they've got a loan from the Federal Home, I think it's from FIDC, Federal Home Loan Bank System. This is really complicated. Then you get the discount window at the Federal Reserve. So there's a lot going on there. So basically, everything and everyone is backstop in First Republic Bank. But if you look at their stock, it's down another 50% today. So there's definitely a lot of panic going on. So let me go to the next chart. This is the one that everyone's showing. This chart here, what you can see here is, let me move myself a little. I'll move it right here. Basically, what you can see is that since 2008, if you remember, 2008 was a really bad time. That was the great financial crisis. Yet, if you look at the available for sale and held to maturity losses, there are nothing compared to what we have here now in 2022. And this is the latest data as of the fourth quarter 2022. I just checked. The first quarter of data is not available since the first quarter is not ended and there's no estimate. But you can imagine that it's gotten worse. It doesn't even have to be worse. It's so off the chart that this is already a crisis right here. And let me just move this down. Now you can see, unlike the title there, unrealized gains and losses on investment grade securities. Maybe I should have made it a little smaller. There you go. So that's the problem. So let's go to the next chart. And you know it's a problem because of this. This here, keep having to move myself. This here is similar to the MOVE index, but it's not. This is the 2-day change in the 2-year Treasury yield. So one or two things to notice. It doesn't have to go down to be a warning. It could go up and down. So when it goes up and down, that's basically similar to the MOVE index. But what I want to focus now is just the declines. So the decline that we've had on the 2-day change in 2-year Treasury yield is greater than we saw during the Lehman Brothers catastrophe in September 2008. And it's greater than during the terrorist attack of 2001. And it's almost as bad as a 1987 flash crash. So this is telling you a few things. Number one, there was the makings of a crisis. And number two, there was very low liquidity in the Treasury market. So things were bad, I'm going to say. And here, what we're seeing is the banking crisis followed tighter lending standards. So that's something I wanted to talk to you about. But before we go there, and I should have put this up here, is this. So I want to talk to you about a few things. And this is where I differ from everybody. Despite what I showed you that the Tier 1 ratio is really worse than it looks. I showed that we have a lot of losses, unrealized losses in investment securities. I showed you that I told you about the MOVE index, and I showed you about the 2-year change declining rapidly. However, what I want to show you now is that I think we're at the days of TARP. If you recall what TARP is. TARP came out during the 2007 through 2009 great financial crisis, the U.S. government threw everything at the financial crisis. And I remember I have a market diary. I started in 2007, and I've been doing it ever since. And I write down everything that's going on. And I write down whether something's noise or it's a signal. And I remember writing this down in 2008, September 2008, I believe it was, that TARP was a turnaround, that this was the end or the beginning of the end of the financial crisis. And why did I think that? Because I thought this was a good solution. And I'm going to read you what I wrote in my notes for the BTFP. So years ago, let's start with the 2007 through 2009 crisis, and then the Asian crisis in 2007-2009 crisis, and the March 2020 COVID crisis, and then the more recent crisis. One thing I should say to happen in similar back to all those crises is that the Federal Reserve and the government took a long time, especially going back in 97 and back in 2008. They took a long time to solve the problem. But this time, and I'm talking about just a week ago, this time the Federal Reserve moved fast, really fast. And I have here in my notes on March, I'm not going to read the whole thing to you, but I'll summarize it. On March 13th, they established the BTFP. And that's just, to me, top, but with different letters. And this time they didn't figure out a fancy acronym. Like when you think of the word top, you think of a protective canvas. But they didn't think of something fancy to make it sell. They just got it out there. But with the BTFP means it's a bank term funding program. And this is what's stemming the bank runs. So even though First Republic Bank goes down between 30% and 50% a day, its shares go down not much a day, I think the bank run is over. And already we saw that UBS is taking over Credit Suisse, and they've got a government backstop. So I'm not worried about a bank run. And let me just explain what this does. The BTFP is where the Fed is offering 1 year on eligible collateral. And that's examples of that are mortgage-backed securities, treasuries, and they give. Here's a deal. Usually, when anyone receives a collateral for anything, there's a haircut. There is no haircut. The Federal Reserve is giving you 100%. They're giving the banks 100% for that collateral. That's amazing. And they're applying the same terms for the Fed's discount window. And this is the traditional lender of last resort. So you don't have to worry about the market value of your pledged collateral. That's amazing. And the rate's not so good, but still, just listen to this. The rate's going to be the 1 year OAS plus a 10 bips spread added to it at a fixed rate. And this rate's about 5%. So I admit that rate's pretty high, but you know what the banks could do or what they're going to do? They're going to borrow at that fixed rate at 5%, and then they're going to invest in participation loans. So what I'm saying is they're going to borrow at 5% and then invest it at loans that are giving them more than 5%. So they get that spread. So if the loan is at 6%, they're going to pay 5 and receive 6. That's like that old-fashioned net interest margin. Is that a good idea in my opinion? No. That's going to raise issues later on. So basically, this is what was called TARP, but it's a new way of the Federal Reserve stemming the bank runs. So let's go to the next chart. So I want to talk to you about liquidity. So people don't know, they're trying to figure out what's going on with liquidity. Is it going up or is it going down? Now, I think it's going to sound very confusing and contradictory, but what I want to say is this. Stated liquidity is going up, and that's because of global liquidity is rising. And this is China. We talked about this already. Chinese liquidity is going up, and China accounts for a large portion of liquidity. And stated liquidity from the Federal Reserve is going up dramatically because of what I just talked to you about. And I showed you that headline about $2 trillion of liquidity going up. And also, I don't have a chart to show you, but there's something called quantitative tightening. And that's supposed to be a reduction of the Federal Reserve's balance sheet by $120 billion a month. My friends, that is not going on anymore. And as a matter of fact, that reduced to about $60 billion a month. And now it's actually going up dramatically. There's like a V-shaped recovery in the Federal Reserve's balance sheet. And this is why long duration hard assets such as gold and Bitcoin are going up, because the quantitative tightening is moving to quantitative easing again. However, I still think there's something else going on. And this is what I talked to you about, the bank hugging you and someone hugging you and backstabbing you at the same time. Because at the same time that stated liquidity is going up, the banks themselves, not the Federal Reserve, not the government, the banks are pro-cyclical. So the banks are scared to lend. That's the problem. So even though I just said that some banks are going to be participating in loans and buying up some loans with with what they're borrowing, overall you're going to see tighter lending standards. So overall, in the longer term, you're going to see some bank tightening. So I know this is confusing, but I think we need to be aware of what's going on. But in the end, I'm going to show you what's going to go on, and I think it's right now. Before we talk about that, I want to talk to you about what I just mentioned before. So I think there's a lot of false narratives going out there. So because of what's going on with the bank runs of Silicon Valley, for example, and the potential, and the one that's not potential, the one that's going on with First Republic, what's happening now is that Bitcoin made a dramatic move, and gold and silver made dramatic moves. But I want to focus just on Bitcoin. Bitcoin hit a low of around $16,000 after the FTX scandal back in November 2022. And now it's at around $28,000. And because of the bank runs and easing of liquidity or stated easing of liquidity, the former Coinbase CTO, his name is Belaji, he's making a bet that Bitcoin's going to hit $1 million in 90 days. And this is what scares me about the market. There is so much bullshit memes and narratives out there. And this is the epitome of what I'm talking about. I think that Bitcoin is lucky to hit 30,000. That's it. There's a huge amount of resistance. If you're looking at your chart, there's a huge amount of resistance at that price. There's actually the resistance around 28,000, and then there's more resistance at 30,000. And remember, you have to look at other indicators. Right now, as we speak, there's a lot of sentiment turning from bearish to bullish. And if you remember, those sentiment indicators, they're contrarian indicators. So when everyone starts turning bullish, that's when Bitcoin's price starts going down again. So I'm sorry, I like Bitcoin in the long term, but I think we're going to have a very difficult time getting over $30,000. So $1 million is like completely off the table. And we also know who's looking for $1 million in the next few years. Yes, Kathy Wood. She's looking for $1 million in Bitcoin. But I'm sorry, that's not going to happen. So just to wrap everything up, because I know this sounds confusing, I think there is no bank run. There is no bank crisis. So before I show you the next few charts of where I think the crisis is going, I'm going to talk to you why I think there is no crisis. What we have from the last few weeks is a canary in the coal mine. That's what we have. Maybe it's a little bigger than a canary. Maybe it's more like a chicken or a rooster. But it's more like maybe more like a rooster because it's really loud. And here's why I want to talk to you about it. I remember as a boy, I remember the savings and loan crisis. And if you recall, well, look it up in your history books. The savings and loan crisis started seeding. It started slowly back in 1986, and then it hit a crucial point in 1990 as rates started rising. Remember that rates started rising, liquidity started getting tight. And that's when, as Warren Buffett said, or was it Charlie Munger? They said, you don't know who's swimming naked until the tide goes out. And for me, the tide going out is evaporation, the disappearance of liquidity. And if you look down there, I did a video on liquidity because to me, liquidity accounts for everything. Movements of all or most asset prices. So let's recall that savings and loan crisis took a long time. Let's go to the next crisis, the Asian crisis. I think I need a drink. I'm losing my voice. The Asian crisis, excuse me, that crisis started in Thailand back in 1996. But no one thinks of the Asian crisis occurring in 1996, do they? No, I think of the Asian crisis as being 1998. Again, there was tighter liquidity, rising rates, a stronger dollar. And guess what? The Asian crisis, it seeded in Thailand, but it did not hit, it did not go in stride. It didn't hit its peak until 1998. And then, of course, the Asian crisis turned to our crisis because of what happened with long-term credit, long-term capital. Remember that one? That was run by geniuses. Remember the guys that invented the Black-Scholes merchant model, the option pricing model. And that occurred because of some assumptions that just didn't work anymore about Russia and sovereigns not defaulting. Well, guess what? Sovereigns do default. So again, remember, what I'm trying to tell you is that crisis took a long time. Okay, let's go to the next crisis. The next crisis was 2001, or maybe it started in 2000. You remember, the tech bubble peaked and the NASDAQ on March, I'm trying to remember the date, I think it was March 15 of 2000, something like that. The NASDAQ peaked at around 5,000. But it was only financial assets, right? But that was the beginning. That was a seed. There was a financial bubble. Ask Jonathan Grantham over at GMO. He can explain everything to you. He predicted it. So, but what I want to talk to you now is length, duration. So that crisis started, in my opinion, at the peak of the NASDAQ. Now, think about what happened. The NASDAQ went down. Rates were strong. Again, liquidity got tighter. So liquidity got tighter, our stocks were starting to crash. But then we had the terrorist attacks on 9/11. That was awful for so many reasons, but it was also awful because it made a financial disaster from what began as a slow-moving avalanche, a slow-moving landslide in the NASDAQ, and then it became an earthquake. The whole thing just blew up. But guess what? That was 2001. But how many people think of the crisis as being a 2000 event or even 2001? My point is, it didn't bottom. The market did not bottom until 2002, October of 2002. So that's the problem there. These crises take years. So let's go to the next one. The next one is what we think of as being the 2008 crisis. But guess what? It started in 2006 when the no-name subprime companies went bust. Then in March of 2007, New Century, one of the largest subprime companies, went bust. And then we know about Bear Stearns' hedge funds. I think they had 3 of them. They went bust. And then in August of 2007, BNP said that they could not price their funds. So think about how slowly that went. That was 2007. And guess what happened in October 2007? Well, usually the market bottoms in September and October. But guess what? The Dow Jones actually hit a new high in October of 2007. So the crisis didn't actually occur until September of 2008 when we had the Lehman crisis. And then the economy and stocks kept declining. So here's my point to you. My point is, I've probably said it 3 or 4 times again, is that these crises themselves and recessions take a long time, at least 2 years. So what we had now was only the beginning of the crisis. This is not the crisis. Now I'm going to show you what the crisis will be, where it's going to be. It's going to be this. And if you look at this is pension funds, private equity allocation. You could see the allocations have been going up, in my opinion, dramatically. If you recall, traditional pensions were 60-40, right? They were 60-40 invested in equities and in treasuries. That's it. It was that simple. They kept it simple, stupid. But what happened was, as you know, treasury bonds have been in a bull market, and those rates have been declining. So when rates decline, treasury bonds go up. That's why I said a treasury bull market. But what happened was that the Europeans made rates zero, negative. That's why we had $19 trillion in global bonds with negative yields. So what happens when you have 0%, nearly 0% Fed funds rate in the United States, and you have basically 0% rates? You have asset managers seeking yields. So pension funds moved from being 60-40, which worked, to seeking yields and hiring lots of consultants and trying to figure out what to do. They weren't earning enough money. So what they did is they hired these consultants, and the consultants told them this. It's not just pension funds. The consultants told them, you got to put money into real estate. You got to do like David Swensen over at Yale. And he's the one that changed portfolio management. I believe for the better, but the problem is some pension funds and a lot of asset managers, they move it in a herd-like way, I should say. And what happened is that everybody, the pension fund, family offices, hedge funds, endowments, all these, and it's not just simple investors, all these sophisticated investors, they all moved, like I said, to real estate, but they also moved to private equity, and they moved to private debt. And I don't know exactly what they mean here by private equity, but to me, private equity means leveraged buyouts, but it could also mean venture capital. And some of these venture capitalists are investing directly or indirectly into crypto, but you don't need to be invested in crypto to lose money. There's a lot going on. So the problem is that they were seeking yield in private equity. And here's a problem. There's two problems. Number one, they look like they're getting high yields, and they were reporting high returns. I'm not showing you returns here, but they've been really high. And the problem is they're showing high returns and low volatility. So that gives you a low Sharpe ratio and a high alpha. But the problem is that anything that's private is not being marked to market on a frequent basis. And so these funds are not being, these investments that the pension funds are doing are not being marked to market enough. And I should say they're not being marked down. What I want to show you, which I didn't, was Tiger Management last week marked down their venture holdings by 33%. And this reminds me of, does it remind you of something? This is like what Mark Twain said, that history doesn't repeat itself, it rhymes. This reminds me of the slow markdowns in CLOs, collateralized loan obligations, and collateralized debt obligations. They got marked down very slowly, and they were AAA rated by S&P and Moody's. So they got marked down very slowly, maybe by 1%. So they were worth 99% on the money. But we also saw that ABX index that was down much more. I could explain that later. But basically, an ABX index was a way of shorting all these CDOs and CLOs. But my point is that if something is private, it doesn't get marked down quickly enough. And so the pension funds are shown much better returns than they really have. So let me go to the next chart. So that was private equity. Now this is private credit. So you're going to see the same thing, that private equity, their allocation, this is North American pension funds. This comes from Preqin. What they're shown is that pension funds have been increasing their allocation to private credit. So while I'm not showing you is real estate, So there's a different ways of saying this. So there's private equity, that could be venture capital. There's private equity. And then I think there's another bucket, and that's real estate. And that's another problem area. So what I want to explain to you where I think the financial crisis is going to be. So it's not what's going on now with Silvergate and the bank run. That's not bank runs. That's not it. The issue is credit. I think credit is going to blow up, and this is going to take time. So it's like what they say about bankruptcies. Bankruptcies start really slowly. Things get worse, and then boom, you go bankrupt. The same thing's going to be with credit. If you look at the high yield index, credit spreads are very low. They are not in crisis mode. But here's a problem. You're going to see issues blown up with private credit and private equity. And then you've got the separate issue or related issue with venture capital and commercial real estate. And we saw what happened at the beginning is what happened with Signature Bank out of New York City. Signature Bank is a bank that deals with crypto, and everyone knows that. Well, some people know that. But that's not why they failed, in my opinion. If you look at office vacancies, they've been creeping up higher and higher. So I think commercial real estate and REITs and office buildings, these are all going down. And so that's, my friend, is where we're going to get the crisis. But this is not going to be now. Right now, we're going to solve the bank run crisis and the liquidity crisis and deposits leaving banks. We're going to solve that. The problem, like I said, is a credit crisis. You can actually have stocks going up now, and you could have everything being hunky-dory. But later on in the year, I think it's going to be September. That's what my placeholder is. I think by September of this year, that's when we have the real crisis. Now, you might be asking me a question, Dominic, why are you saying it's going to be so soon when you said these crises take like 2 years? Well, a few reasons. One big reason is that the U.S. economy and even global economy has become monetized. Debt has moved from the consumer to the government. And you've seen that already just with what I'm explaining to you now. The government, maybe I should show you that slide. Right here. You could see here, it's saying that Fed loans will provide $2 trillion of liquidity. This is a prime example of what I'm talking about, of the Federal Reserve, or the U.S. government, I should say, monetizing the economy. Right now, total debt to GDP is reaching 4 times. And this does not even include what's called off-balance sheet debt. That's another animal. So what I'm saying is, because the U.S. economy is so monetized, it's very sensitive to changes in GDP growth. So as soon as the unemployment rate goes up, we're at very low levels now. As soon as that rate reaches 4% and people start losing jobs, so it's not happening now, but it's starting to happen in the tech area. So as soon as the labor market weakens, as soon as that market weakens and people start losing jobs, that is when the economy is, and the shit's going to hit the fan. And that's when we're going to have a financial crisis that's equivalent to what we had in September of 1998 and September of 2008. And yes, these things tend to happen around September and October. It's a seasonal thing. So that's all for today. I hope this was clear to everyone. And again, I just wanted to say, because I think the crisis is not happening now, I think the Federal Reserve is going to raise rates by 25 basis points within the next day or two. Well, thank you all for listening. And don't forget to like us at Lamb's Cryptoverse.